Gold has been a disappointment to investors who might have hoped that inflation would lift the price to new record highs and keep it rising. But of course, interest rates went up, and that put a damper on bullion. Real interest rates, when they're high, is said to be negative for gold. However, our guest says that in the next couple of months, gold could well move back up into record territory. We are joined by Ghali. He is a senior commodity strategist at TD Securities. It's great to see you.
Thank you for having me back.
I know the timing is uncertain, but it looks like the Fed will start cutting interest rates this year. And typically, gold does well at the start of a cutting cycle.
Yeah, historically, gold certainly benefits from what you would call the real Fed funds rate, right? So as the Fed cuts inflation on the back of a more tame inflation outlook, gold does tend to do well. But here's the interesting thing, Andrew. I think for the first time in nearly several decades, gold investors are historically underpositioned in gold ahead of a Fed cutting cycle.
Oh, so that's unusual this time around?
That is absolutely unusual. And you know what, when you think about it, most of the indicators that gold investors typically look at, things like real rates that you mentioned, the US dollar, et cetera, have kind of led them astray over the last several years. They've been repeatedly wrong-footed by those kinds of indicators. But if you look several decades back, there is precedent for this kind of context where physical markets are doing a lot of the heavy lifting and investors just keep getting it wrong.
Let's have a look, say, at a 10-year. Oh, there's a 1-year chart for gold, pretty good. Maybe we'll have a look at a 10-year chart for gold. I guess another bullish factor, I don't know if it factors into your models, is all this central bank buying we're seeing.
Absolutely. If you break down gold demand into two categories, let's call the first financial flows and the second physical flows. Physical flows, including central banks, have been doing most of the heavy lifting for several years now. Right, and the reason is, in the midst of the most aggressive Fed tightening cycle on record, investors have been consistently trying to short it, and they're doing that again today after the string of hot data that we've had out of the U.S. But central bank buying, very strong appetite out of the East, is offsetting those flows and actually keeping gold prices relatively close to all-time highs already.
Is that partly because people are worried about the huge U.S. debt load?
That's part of the story, but I think if you zoom out, there is certainly a mind shift with respect to central banks in the global south since the war in Ukraine. Right? The risk that of a nation's foreign exchange reserves could be confiscated they are moving against Western interests. That factor caused a mind shift for many nations.
That's interesting. The seizure of Russian assets.
Absolutely.
In other words, yeah. Yeah, and also I guess the West has shown its willingness to curtail countries' exports by sanctioning insurers and shipping companies as well.
Yeah, absolutely. And if you think about the incentives for many of these countries, let's talk about the Gulf nations.
Okay.
They've had a historic meeting, the first of its kind, with President Xi of China in December of 2020. Time's passing fast, but 2022, I believe.
Okay.
And in that meeting, they've agreed to an all-out energy cooperation, which entails eventual purchases of crude oil in renminbi terms. In order for the Gulf nations to accept that kind of agreement, they need more confidence in these kinds of currencies. And that demands that China buys more gold in order to back its currency, or the confidence in its currency.
So we might finally see the undermining of the US dollar as the medium of exchange for oil, or the only important one.
Right. Well, I mean, that's certainly part of the story here. At the very least, some nations are hoping to diversify away from the US dollar.
That is interesting, isn't it? Because gold, if we look at that 10-year chart again, it was frustrating, wasn't it? People thought that inflation would be a boost. I mean, by definition. But the higher, I guess the aggressive increase in interest rates was one thing that deterred gold investors.
Right, that's precisely it, right? And today what we're seeing is this kind of Pavlovian response. Investors are seeing a string of hot data and they automatically expect that the better trade is to fade the Fed. But in the current context, the Fed is trying to engineer a soft landing. And as long as we don't get a surprise on the inflation front, they could be set to cut rates as soon as May. That's a very positive outlook for gold, and investors are very underpositioned for it.
Yeah, It's an interesting one. Do you have a take for investors? What is it good to buy an actual ETF, or I know you're not an equity guy, but do you have a preference? Should people just buy a straightforward ETF that holds gold bullion or a gold mining ETF?
Well, there's a variety of ways to get exposure to this, right? ETFs are certainly one of the commonly used ones. In recent times, there's been actually a lot of disinvestments from ETFs, and alongside the same theme that we're talking about as investors are liquidating. But there's really a variety of ways that you can get exposure to gold.